SCHD is one of the most popular equity ETF in the market, offering exposure to a broad range of US stocks with high dividend yields. SCHD tracks the performance of the Dow Jones US Dividend 100 Index, which is composed of 100 high dividend yield US stocks. The ETF offers exposures to a broad range of industries, including finance, utilities, and consumer goods, and seeks to provide investors with high income and long-term growth potential. It offers a straightforward low-cost fund, offering potential tax efficiency. The fund can serve as part of the core or complement in a diversified portfolio, tracks an index focused on the quality and sustainability of dividends, and invest in stocks selected for fundamental strength relative to their peers based on financial ratios. So SCHD seems like a good ETF to invest in. The question is it worth it? Let's find out. The fund is trading for around $76 a share with an expense ratio of 0.060%. That expense ratio is low, so that's good, and expenses are covered by dividends. The fund was created in 2011 with $43 billion of total net assets, and it has 607 million shares outstanding. It has a total of 104 holdings, and it has a portfolio turnover of 14.99%. The lower the turnover, the better. This means the fund manager does not trade positions a lot. With that being said, it's safe to say that the investing style of the management is passive. We can deduct from this that this is a buy and hold. The fund has a dividend yield of 3.39%, which is very nice and conservative, a PE ratio of 14.91%, which makes it undervalued compared to the market average, and a 3-year beta of 1.00, meaning that it moves with the market. Taking a look at the top 10 holdings, we can see some recognizable names. High-quality dividend payers that have increased their dividends through decades regardless of market condition. To name a few, we have Texas Instruments, Home Depot, Coca-Cola, Pepsi, and the list goes on. It's also diversified by sector. The fund is invested in all market sectors except for real estate, having tech as the largest portion with 21% and utilities as the smallest with 0.26%. Worth mentioning that most of the money in this fund is invested, 99.97% in stocks and only 0.03% cash. The fund pays a growing quarterly dividend. They started paying 19 cents per share in 2013 and now they're currently paying 70 cents per share. The 10-year compounded of this ETF is 12.20%. That is massive. Early investors must be banking a decent amount of cash flow right now. Comparing the performance of SCHD versus BOO, which is Vanguard low-cost ETF that tracks the S&P 500, as long-term investors, we should ignore the short-term fluctuations, but for example purposes, we will include them in this example. In the 1 month, BOO is winning by a small percentage. Same with the year to date. When we start looking long-term is when we see SCHD shining, beating the market in the 1 year, 3 years, 5 years, and 10 years mark. So what's the takeaway? We have a cheap, low-cost ETF that pays a fast-growing dividend, is currently beating the market, well diversified, the company it holds are high-quality businesses, and is managed by a respectable company, Charles Schwab. SCHD since inception has demonstrated that it's a high-quality ETF worth keeping an eye on, and it could be a good alternative to add to your portfolio. So let me know in the comment section below if you own SCHD and how this ETF has treated you. I do not own SCHD, but could be planning to add in the future. That will be it for this video. Take care, and until next time.